Portfolio Construction and Risk Management, Chapter 6, Portfolio Risk Metrics. Section 5, Risk-Adjusted Returns. A return number tells you where a portfolio ended up, but not how rough the journey was along the way. Risk-adjusted return helps us compare how efficiently different portfolios turned risk into reward, so two portfolios with the same gain may not be equally impressive. In general, the smoother path has earned that return more well. Total return by itself can be misleading because it ignores what had to be endured to get there. A manager might post strong gains by taking on much more volatility, deeper drawdowns, or even leverage. That's why risk-adjusted metrics are so useful. They help separate genuine efficiency from simple risk-taking. There isn't one perfect measure of risk-adjusted return. Some tools focus on total volatility, some on market sensitivity, and others on the size of the worst decline. Because each one captures a different kind of risk, the best metric depends on the question you're trying to answer. The calculation is simpler than it may sound. First, choose the kind of risk you want to measure. Then calculate excess return by subtracting the risk-free rate from the portfolio's return. After that, divide that excess return by the risk measure to see how much reward the portfolio produced for each unit of risk. Many familiar ratios follow that same basic structure, but they plug in different definitions of risk. The Sharpe ratio uses standard deviation, while the Trainer ratio uses beta. In both cases, a higher ratio usually points to better efficiency, but only when you're comparing results in the right context. Let's make it concrete with two funds. Fund A earned 12% and Fund B earned 10%, so at first glance Fund A looks stronger. But once we compare excess return to volatility, Fund B actually delivers more return per unit of total risk. After adjusting for the 2% risk-free rate, Fund A has a 10% excess return and Fund B has 8%. Even so, Fund B's much lower volatility gives it a higher Sharpe ratio, 100 versus 0.67. So the ranking changes when we focus on risk-adjusted performance instead of return alone. Different risk measures can change the conclusion. And that's exactly what this comparison shows. Using Sharpe, portfolio Y comes out ahead because it has less total volatility relative to its excess return. Using Trainer, the two portfolios tie, because once we look only at market risk, they deliver the same reward per unit of beta. Risk-adjusted metrics are powerful, but they're not meant to be used in isolation. Different ratios measure different kinds of risk. Unusual return patterns can distort the results, and historical ratios only tell us about the past. The best approach is to use these tools together, with consistent inputs and a healthy dose of judgment.